Good afternoon, everybody, and welcome to our latest webinar in our tax update for professionals series. Today, we'll go through the main tax announcements from the spring statement, but as you're probably aware, there weren't that many, so we'll also cover off some topical tax issues as well. Please use the Q&A function on Zoom to ask questions. And if you don't mind, we'll just pick those up at the end and deal with them in one go. As always, the presentation will last approximately 45 minutes. And we have the usual 4 speakers from Brown Butler. There's myself. I'll be talking about corporation tax and business taxes. Vicky Hughes will deal with private client matters. James Hurst will then cover off VAT matters, and finally we'll have Paul Clark, who will talk about the latest issues in tax disputes and resolution. Now, the webinar is being recorded and will be available to watch again, should you wish, via our website. Probably by the end of the week, we'll have that uploaded. Okay, so starting off on corporation tax and business taxes. As I mentioned, the spring statement itself was very light on tax issues, and in particular around direct taxes, although there were some announcements which are worthy of mention. I suppose the one that got all the headlines was the increase in the national insurance threshold to £12,570. Now, this is coming into effect from July 2022 rather than April. And I think one of the reasons for that was to allow software developers time to get the systems up to date. Now, of course, what that does mean is that the national insurance threshold is now aligned with the income tax personal allowance. And whether that is just an administrative easement, or it could be a sign that perhaps sometime in the future there may well be some alignment of income tax and national insurance. Certainly it would make the tax system a lot simpler and more straightforward if those two taxes could be aligned. Now, one of the impacts of that increase in the national insurance threshold is that it's going to cost about £6 billion. And of course, the whole purpose behind the increase was to help fund social care. It's the Health and Social Care Levy. And so clearly that's going to leave a hole in that funding now, which will need to come from somewhere else, I presume. Keeping with national insurance, the employment allowance, that increases by £1,000 to £5,000 from the 6th of April. And there were some consultations which were announced. A couple of areas of note here. First of all, there's going to be a consultation around incentivizing capital investment. And what this is looking at is how effective is the current tax system in terms of incentivizing capital investment. So we have the annual investment allowance, we have the super deduction for a couple of years now, and we obviously have the normal writing down allowances. And essentially everything is up for grabs at the moment. So we may have an increase in the annual investment allowance on a permanent basis. There might be some first year allowances for particular types of expenditure. Super deduction, that may be retained in some form or another, or the general writing down allowances may well increase. Just need to wait and see on that. It was also announced, as far as R&D is concerned, that there is going to be, or they are looking at, a reform of the system. One possibility there is we may have a single regime. As you may know, at the moment, we have a regime for SMEs and one for large companies. They work on a completely different basis, albeit the qualifying expenditure is broadly the same between the two. So there might be a combination of those two regimes into a single one. More details will be announced in the autumn budget. Now, the Health and Social Care Levy is still going ahead from the 6th of April 2022. There was some speculation beforehand that this may be deferred for a year, but that proved to be incorrect. And so from 6th of April, we have this 1.25% increase in national insurance for employees and also unincorporated businesses, and also, of course, on dividends. Now, something which was announced, which is a bit of a jam tomorrow as such, is a reduction in the basic rate of income tax to 19% in 2024. Now, it was an announcement that was made. Whether that will come to fruition or not, we will see. There is, of course, due to be an election in 2024, so it may be that it's no coincidence that a tax reduction would be announced at around the same time. Just one thought on the increase in national insurance. It does make salary sacrifice potentially even more appealing now. Pension contributions and electric or low emission cars are two examples where salary sacrifice can work very well. We do need to be careful around optional remuneration arrangements in terms of how they interact with salary sacrifice, but nevertheless, it's something that may be more in focus now with the increase in NI rates. Now, just the last slide that I wanted to cover off was around the change in basis period for unincorporated businesses. Now, it's very important, and it is worth mentioning. I did bring this up in the last presentation that we did 3 months or so ago, but it'll be here before we know it, and there are certain things that we may need to be thinking about sooner rather than later. And just as a reminder or as a refresher, from the tax year 24-25, profits of unincorporated businesses will be taxed on a tax year basis, irrespective of the year end of that business. And there is a transition year in 23-24, which will bring profits into line so that from the 6th of April 24, we're fully within the regime. What that transitional period will do is present lots of challenges for businesses that don't have a 31st of March or 5th of April year end. We're undoubtedly going to be in a situation of using provisional or estimated figures. And at the moment, there's still no mechanism that has been blessed by HMRC in terms of how those provisional figures and estimates are going to be dealt with. Now, one of the simplest things to do here would be to change the year end of the business in advance of the new rules coming in, such that the business has a 31st of March or 5th of April year end. Now, there are some issues around the timing of when you might want to do that, either in 2022-23 or 23-24. If it's in 22-23, then you won't be able to take advantage of the ability to spread the profits in the transition year over a 5-year period. Because in this transitional period, we are going to have more than 12 months worth of profits being taxed. And so there are some relieving provisions in there to allow you to spread that over 5 years, to avoiding an upfront tax hit. Like I say, even though it's a couple of years before this comes in, because the transition period is only 12 months away, we should start thinking now about year ends and whether we should change them, etc. Because the changes will have significant cash flow implications, which businesses need to be mindful of and be fully prepared for. Okay, that's all I wanted to talk about from a business tax perspective. I'll now hand you over to Vicky, who can bring you up to date with what's been happening in the world of private client. Thank you, Vicky.
Good afternoon, everyone. I'm going to talk to you about the trust register, particularly in relation to registrable express trusts that have no tax liability. Hopefully this isn't something that comes as a surprise. I did touch on it in the last presentation that we did, but hopefully this will give you more information and help you with the discussions that are probably ongoing with your clients at the current time. So as a reminder, since 2016-17, trustees of certain trusts have had to register trusts online with HMRC using the trust registration service and have had to keep that information updated. Those trusts that have been affected up until now have all had tax liabilities, and the particular taxes are summarised on the slide there. So it's been a way of trustees providing information on a trust to meet anti-money laundering obligations. Unfortunately, due to the Fifth Money Laundering Directive, the scope of the trust register has been significantly expanded, and this now captures a very significant number of trusts that don't have ongoing tax liabilities but still need to be entered onto the trust register. And the deadline for adding this a large amount of additional trusts is the 1st of September this year. So it's not very far away now, and it needs to be addressed as a matter of urgency with clients and other parties that are affected. So moving on to the next slide, we can see here just a recap of the deadline. So here we're focusing on the non-taxable trusts. So these are ones that have been in existence on or after the 6th of October 2020, and they need to be registered by the 1st of September this year. If they were created after the 1st of September 2022, you've got 90 days to get them on the register. And obviously, if some are created within 90 days of the 1st of September, it'll be a rolling deadline 90 days after they've been created that falls after that 1st of September date. If there are changes to the trust details or circumstances, then those need to be updated on the register within 90 days of those changes happening. So we're saying that a number of additional trusts are caught. That's because all UK Express trusts have to register whether or not they have a tax liability, unless they fall within a certain category of exclusions, which makes them an excluded trust so that they don't have to go on there. Trusts may have already been registered, for example, because they had a tax liability after 2016-17 that's now ceased. But for a number of those, you'll have to provide additional information. And where there are non-UK Express trusts, they might have to register on the trust register as well. I think usually for those of us on this call, we'll be dealing with UK Express trusts. But if you do have non-UK trusts, there are certain circumstances, as highlighted here, where they'd still have to go on the trust register. Third parties will be able to access some of the information on this register, but it will be very much monitored and restricted by the revenue. And there will be penalties imposed if the details aren't completed, although it's hoped that these will be done on a soft basis to start off with. So now I'll move on to talking about some of the exclusions that apply. And I just want to remind you that these exclusions only apply to the trusts that don't have an ongoing tax liability. So long as you don't have a tax liability applying to the trust, it may well be that one of these exclusions means that you don't have to enter them on the trust register. So if you've got trusts used to hold money or assets of a UK registered pension scheme, so for an example, an occupational pension scheme or SIP, they shouldn't need to go on. Trusts used to hold life or retirement policies hopefully won't have to go on. And when I say hopefully, that's because providing the policy only pays out on death, terminal or critical illness or permanent disablement, or to meet the healthcare costs of the person assured, they wouldn't need to go on. But if for any reason you've got a trust that's holding some element of that, and for example, an investment bond that gives an investment return, it would have to be entered on the trust register. Trusts holding insurance policy benefits that are received after the death of the person whose life was assured won't need to go on the register, providing the benefits are paid out from that trust within 2 years of the date of death. Charitable trusts wouldn't normally need to go on there. And pilot trusts that were set up before the 6th of October 2020 and that don't have more than £100 worth of value in them wouldn't have to go on the trust register either. Continuing with a summary of aspects that are excluded, co-ownership trusts are set up to hold shares of property or other assets that are jointly owned by two or more people. So, for example, often homes are jointly owned either as tenants in common or joint tenants. Provided the trustees and the beneficiaries are identical, those wouldn't have to go on the trust register. It doesn't matter if the percentage shares aren't 50% each, provided the beneficiaries and the trustees are identical, that should fall within the exclusion. Will trusts that are created by a person's will and come into effect as a result of their death don't have to go onto the trust register, providing that the estate is wound up within the 2 years. Otherwise, if they continue into existence beyond that 2-year period, they would then need to be entered onto the register. Trusts for bereaved children under the age of 18 or between 18 and 25 set up under a will or intestacy of the deceased parent, or the criminal injuries compensation scheme wouldn't have to go on there because they're automatically set out in legislation. Financial trusts created in the course of professional services or business transactions for holding client money or assets wouldn't need to go on there. And also trusts imposed by a court order don't have to go on the trust register, but it's important to realise that that has to be a specific court order. If it's just a separation agreement, that wouldn't count and it would have to go onto the trust register. So there are some exclusions, which is good news, but there are some scenarios that you might not expect to be caught by this trust register, but do have to go on there. So bare trusts, unfortunately, have to go on the trust register unless they fall within one of the other exclusions. Trusts holding investment bonds would have to go on there. So, for example, that would include discounted gift trusts. Pilot trusts that have been set up to receive pension, death benefits and life assurance may well have to go on there. But where they were set up before the 6th of October 2020, they should only need entering on the register where the value in the trust is now more than £100. Any new pilot trusts set up since the 6th of October 2020, regardless of the value, do have to go on the trust register. So, for example, if somebody set up a trust a few weeks ago with only £10 in it, thinking they're going to add some other assets, that would have to go on the trust register. And this is one that's going to catch a lot of people. Child ISAs, if you've got minors that have money in ISAs, then those would have to go on the trust register. Now, child trust funds are not caught by this, and child or bank building society deposit accounts that are pure deposit accounts, for example, that a grandparent has set up for a grandchild, wouldn't have to go on there. But if you've got junior ISAs in place or any other accounts holding shares, for example, those would need to go on the trust register, and you wouldn't necessarily think that they would be caught by these rules. Moving on to some other examples of scenarios that are caught. Co-ownership trusts. So this includes declarations of trust over property, where the trustees and the beneficiaries are not identical, would be caught by this. So situations caught would include scenarios where the number of trustees is different from the number of beneficiaries. And for example, situations where you have minors as beneficiaries would be impacted because they can't be trustees. So it would be impossible for the trustees and the beneficiaries to be the same parties. Exactly. Where property is jointly owned, we've said that if it's joint tenants or tenants in common, that shouldn't have to go on the trust register. But care is needed when one of those parties die in particular, because not only might the one of entry need to go on the trust register, but it can actually create two entries, which is something that has really only just come to light and which is a very recent update on the trust register. So that's why I've put reference on the slide here to a particular entry on the trust register that has examples on there to lead you through the example of how, if somebody dies, you could actually end up with two entries needed there. You end up having to consider the property itself and how that's held, because it could, instead of being held as jointly as tenants in common, it's now held as tenants in common with trustees sometimes. And then you've actually got the, for example, life interest trust for the property. that would need to go on there as well. So I really would recommend that you look at that trust update to see whether you have more scenarios than you're expecting to have to go on the trust register. Employee benefit trusts and employee ownership trusts aren't exempt, so those would usually have to go on those, including those that have already been distributed if they existed after the 6th of October. And strictly, even if you've had a trust that was wound up before the 1st of September, if it was still in existence on the 6th of October 2020, that would, according to the guidelines in the trust manual, need to go onto the trust register, only then to be removed. It's a way to protect trustees to make sure they don't get on a naughty list with the revenue, but we do have some practical experience of a trust that was closed, and we contacted the revenue because we'd already submitted a tax return for the period, and they confirmed to us we don't actually have to put that on the register. But I would suggest that you discuss any of those on a specific basis with those at the revenue that are dealing with the trust manual and the trust register, and whether they would need to go on or not. So I know we've covered a lot of detail there, but it really is important to update clients and help them assess whether they're impacted by these rules. The awareness of these rules, I would say, is patchy. For those trusts caught, i.e. you're not excluded from these rules, it could be that these trusts were set up to 80 or even 125 years ago. So there really could be a plethora of trusts to catch that may have been forgotten that they're still in existence. Depending on the situation, you could find that you've got trusts switching between the registrable taxable trust rules and these express trust rules that apply to non-taxable trusts. They are both contained within the same register, but there are different questions that need to be answered. And so it is important that you consider all of your trusts. There is significant information to collate, and it's not necessarily going to be straightforward obtaining that information. You should have information about all potential beneficiaries, so that would include parties included in the letter of wishes, and it's possible that family estrangements could have arisen and that could impact the information that you need to obtain. There are questions on the trust register to do with mental capacity. It is acceptable to answer that parties don't have it. Obviously, you'd expect trustees to always have mental capacity, and if you don't know about whether they do or not of the beneficiaries, to put that, because really this is a way of HMRC monitoring whether they'd be able to contact those individuals if they had any queries going forwards. So if you mark that they don't have capacity, they shouldn't be contacted with any queries. Moving on, just some tips here. I'd suggest that you gather all the information you need first before you start entering it on the trust register, because part completed entries are only saved in draft for 30 days and then they're automatically deleted. So if you do input any information, I would very much suggest you print off copies when you've done that, and then you wouldn't lose everything if that time limit expired. And also I'd suggest you print off entries before you submit them so that you've got a copy of that as well. The system is quite clever in that you input information and it automatically checks it to information within the HMRC database. Unfortunately, that means that if the national insurance numbers or dates of birth, for example, don't tie up with HMRC records, you won't be able to proceed with the registration, and you'd need to liaise with the revenue to correct those underlying records. Hopefully, obviously that won't happen in many cases, but it is something that's being reported as causing problems. There is a detailed trust register manual that has guidance in there and technical detail. It is being updated regularly and the examples being expanded. So I would recommend that you have a look at that and keep an eye on the updates that are happening to it. You do only need one exclusion to apply to prevent the need to register these non-taxable trusts, but there are a large amount of scenarios caught, and you do need to read and apply the exclusions very carefully. And as I've highlighted, it could be that unfortunately you actually end up with two separate entries required on the trust register rather than one in certain scenarios. I would say to take caution and beware of letting scenarios fall between the gap if there's different advisors involved. So don't assume that somebody else is doing it. It would be worth just checking with clients and sending them an update so they're aware of it and they can take their responsibilities forwards, because obviously clients would expect us to make them aware of it and help them if they wanted us to, but the obligation is on the trustees. And it will take time to do this, so consider how you're going to charge clients, what take-on procedures, etc. you're going to do. And there could well be issues to address where the trust doesn't have liquid funds, or there's no ongoing file or contact that you have. It would be something to consider internal policies of what you're going to do to make sure you cover these aspects. So I hope that's been helpful to remind you what's needed. Obviously, please put questions in the question and answers if you have them. But I'll pass over to James Hurst now to talk about his VAT update.
Thank you, Vicky, and good afternoon, everyone. So in terms of the VAT update this afternoon, then I was going to begin with looking at the one real point of note from the recent Chancellor statement, and then move on, which is to do with energy saving materials, and then move on and look at a few recent developments and cases. The one sort of real VAT announcement is around energy saving materials is not huge in itself, but it does throw up a few points of wider interest, I think. And one of these is the fact, first of all, that we've got a new zero rate, which shows us that post-Brexit, we are now sort of less encumbered by following EU law and precedent, and within the UK and our own UK VAT law, we can now create new zero rates. Whereas, so previously, going back to John Major's government in the 1990s, there used to be the case that domestic fuel and power was zero rated. VAT was introduced by John Major's government at 17.5%. Then the Tony Blair's government pledged to reverse that, but they couldn't, because once a zero rate had gone, it could never be restored under EU law. And then what happened was that the VAT rate was reduced down to 5%, which has been with us ever since. This new zero rate for energy saving materials replaces the previous 5% rate, which we've had for a few years now, on things like wind turbines, heat exchange pumps, and solar panels and the like. Another point, again showing a sort of divergence from EU law, is that back in October 19, under EU law, the UK was forced to take water and wind turbines out of the 5% VAT rate because it was incompatible with the EU law. So those particular types of products have been brought back into the relief now. All of this applies to residential installations. One of the other, for me, points of interest is that the previous 5% rate was subject to all sorts of conditions, basically social policy conditions. So in order to get the 5% rate on solar panels and the like, the customer had to be 60 or over, or in receipt of certain government benefits, or be a housing association, or a children's home or a care home, something like that. There was also the 60% test, which said that if the purchase cost of the goods exceeded 60% of the overall charge made to the customer, then only the installation charge benefited from the 5% reduced rate. This new change that comes in from 1st of April sweeps all of that to one side and just says residential installations are going to be zero rated. So there's a clear inducement for people to keep the cost down of installing these things. A contract is for a taxable supply of goods or of services, and that a further payment is made that might be seen as compensatory, but actually that payment is expressly envisaged within the terms of the contract, then that payment is seen as additional consideration within the contract. And so where it's a VATable contract, that should be subject to VAT. And so the situations where compensation payments are outside the scope are probably going to be much fewer in number going forward. If we could just nip back to the previous slide, the preceding slide, because I think there are a couple of points I just wanted to mention there. So just checking, yes, the other point to bear in mind is that it ends this week, the temporary reduced rate of VAT on catering, hotel accommodation, and admission to attractions. That all goes back up to 20% from Friday. Okay, if we can, and I think then we'll just finish with this last slide here, where I've just picked out a handful of recent VAT cases in the courts, just to highlight some of the themes that have come out. The first one about postal services exemption interests me for several reasons. One is that ZipVit has been the lead case on this, and behind it, it's been reported there's been about £1 billion worth of claims have been stood behind the ZipVit case. And a point of interest is that actually this is something that's been fought for over 10 years now. And ZipVit has been the lead taxpayer, arguing that it ought to recover VAT that it paid historically on to Royal Mail for postal services. And the history of this is it goes back over 10 years to the TNT case, which went to the Court of Appeal, and then the European Court. And the TNT case, TNT is a private postal operator doing commercial bulk deliveries, went to court and argued that it was unfair that they had to charge VAT when Royal Mail were carrying out exactly the same sort of services and benefited from the postal exemption, because postage is exempt from VAT. And then the outcome of the case sort of blindsided everyone, because the court said, yes, that is unfair. It's not a level playing field. But that's because Royal Mail should have been charging VAT on certain of their services for years. And all they should be exempting is the universal postal service. So where they do commercial bulk carrying and deliveries, they should be charging VAT. So in fact, in 2011, the law was amended and the Royal Mail now charge VAT. But on the back of that, a lot of taxpayers, thousands of them across the country, submitted claims and said, well, actually, that means that for all the postage that we've paid to the Royal Mail over the years, that had VAT in it, and we ought to recover that, be able to recover that VAT as input tax. And then there was a court case to try and force Royal Mail to issue a VAT invoice for those amounts that were paid. And they refused, and HMRC refused to demand VAT from Royal Mail. And so it's gone all the way through to the European Court. So here's a case where the European Court has found against ZipVit, against the taxpayer, and it's been very helpful to the UK that the European Court has found in that way, because they said, well, the contractual position was that VAT could be added to the postal cost. As a matter of fact, VAT was never added on top of the charges that were made, so no VAT was charged, and that's it. And I think all the way through, the courts have tried to find ways to find against the taxpayer because of the huge cost to the Treasury that would be unlocked. But that's pretty much the end of the line for that strand of litigation. The next bullet point, the case Junji Louis and Jay Lee, is just highlights the perils of, I think, of documentation to do with imports and exports. And in this case, it's the evidence for export. So if you're exporting goods from the UK, you can zero rate them and you don't charge VAT. But in order to zero rate your goods, you have to have evidence, and that's normally commercial evidence, to show that the goods are being exported. In this particular case, there didn't seem to be any reasonable doubt about whether the goods are being exported, and HMRC pursued a real technicality, and they said that, in fact, the descriptions on the commercial evidence, like the parcel force dispatches, they were too vague and misleading, and therefore there wasn't clear evidence that the goods had left the UK. Well, the facts as presented were that the exporters from the UK here were deliberately being vague and putting low values on the parcel force documentation because they were very worried about theft of the goods in transit, goods being sent to individuals in China. And in fact, there was a very full audit trail behind the scenes to show purchases of goods and true values and things like that. But on a technicality, HMRC really pushed this one, got a big assessment, and the tribunal upheld it. The next case, another recent case, Hotel Latour, is looking at the VAT incurred by a holding company on the sale of a subsidiary. It's always a tricky area of VAT. And in this particular case, the holding company and the subsidiary were grouped together in a VAT group. The subsidiary was sold off, and meaning an exempt sale of shares, costs were incurred, and the holding company sought to recover that VAT, and HMRC said, no, those costs relate to an exempt sale of shares, you can't get it back. But Hotel Latour successfully argued that, in fact, they were selling off one hotel business in order to raise funds to invest in another hotel business. Hotels are a taxable activity, and they demonstrated to the satisfaction of the courts that there was a clear and direct link between the costs incurred and the taxable activity there. And then my final point is something that comes up reasonably often. In this case, in the Errol Willey Salons case, Mr. Errol Willey is a hairdresser in Cardiff and got an assessment for £18,000, having rented out 2 spare rooms to beauticians. He had 2 spare rooms above his hair salon. He rented those out and took the sensible view that that rental was exempt from VAT because he was giving them a right over land. And HMRC disagreed, and they said, oh, well, those beauticians, they've got access to the staff room and the staff toilets. They benefit from reception, light and heat, advertising. There's a whole package there, and they should have been charged VAT on this. The tribunal has thrown that out, and it's interesting for us in VAT because HMRC have had a real difficulty over the years with hair salons and renting out chairs to other hairdressers, and trying to it was they changed the law, and they specifically say for hairdressers, if you have chair rental to other hairdressers, that's specifically covered by the law as being standard rated. But in this case, it sort of upholds the point that if you rent out a room to someone, even with some incidental services, it doesn't change the fundamental nature that there's a passive activity of renting out land to someone, and that should be exempt from VAT if you've not opted to tax. And on that note, that concludes what I wanted to say today about VAT.
Good afternoon, everybody. We'll take a quick look now at how the spring statement impacts the field of tax investigations and inquiries, or more specifically, these days, HMRC use the expression compliance activity. It was stated last week that there's going to be a further investment over the next 5 years of £161 million in this area of activity by HMRC, not only to increase the compliance review activity of taxpayers, but also, interestingly, the debt management side now is also being mentioned. And one of the startling statistics of the investment that HMRC place into compliance activity is the cost ratio yield is significant in that it brings in huge amounts relative to the investment that they put into it in monetary terms. And they're forecasting in this situation to bring in, so it is said, more than £3 billion of additional tax revenues. So how will they look at this? Because what they do is typically to put more resource into investigations and inquiries. But also what they're looking to do now is to reduce what is an ever increasing mountain of tax debt. This is amounts that are broadly agreed that HMRC are owed the amounts of money. So it's gone beyond the inquiry stage, but it sits with HMRC's debt management and banking unit. And what we expect to see more of in the coming years is far greater focus of debt management's recovery of this ever increasing amount of debt arrears. And we've seen in a case here, for example, where the case was closed with the investigating officers over 12 months ago, leaving an amount still outstanding to HMRC, now in the hands of debt management colleagues in HMRC. And they still haven't got on the case to collect what is a significant amount of money. There's no doubt that it is owed in principle, and particular circumstances gave rise to it not being able to be collected at the time the case was closed by the inquiry inspectors. So it still sits in debt management's books as owing to HMRC, but here we are over a year later, and there has been no contact from debt management. Will there ever will be? Well, we'll see. And I think for more recent cases, we will start to see greater contact from debt management now. What the statement also said was that we should, if we look at the total investment that is going into HMRC's compliance work, you can see in the coming years how much of an increase it is going to be. In the current year that's coming to a close, it's £85 million, increasing next year to 455 million, and increasing yet further in the following year to 855 million, and remaining at that level for another year before it starts to come down somewhat. But it's significant, the amount of funds that is now going to be placed into what they now call compliance work, the field of investigations and inquiries that as we know it. One of the matters that I mentioned last time round when we presented back in November was the announcement as then that when the Finance Act 2022 did receive royal assent, it would then quickly bring in a new package of measures to tackle the promoters of tax avoidance schemes. And that has now come into being a month ago. One of the measures that HMRC announced some time ago, and they make no secret of this, is they wish to drive out of the market the promoters of tax avoidance schemes. And here's a very, very current example of what their activity is, bearing in mind that they would far rather have no tax avoidance scheme promoters out there rather than have to go after cases that are now historic and dispute whether those schemes ever were successful in putting steps together that avoided how the legislation would otherwise apply. And here is a case that went to the upper tribunal, and the decision was announced earlier this month. And it demonstrates how in the past it's been difficult for HMRC to try and go after the offshore promoters, and there are a number, and have been a number, particularly over in the Isle of Man. And here is a case, there's a firm known as Aml Tax that was put into being by quite a well-known couple of practitioners on the Isle of Man. And they took the view that what they had put in being was basically for them to retain ownership of. And if HMRC asked for documents, then they would be very reluctant to hand those over. What HMRC typically do when they are looking for information within their powers, their main piece of legislation is what's known as Schedule 36 to the Finance Act 2008. And it enables HMRC, so long as they can demonstrate that they are reasonably requesting the information from typically the practitioners, then they will be able to do so because the tribunal will find in their favour. And that's what happened in this particular case. And AML Tax were very reluctant to hand over a number of documents that HMRC were able to obtain from them. And the tribunal judge basically said that the firm were evasive and displayed a lack of candour. And this was typical of the way that the HMRC counter avoidance unit work. They are solely looking at whether tax avoidance schemes are effective. And we have seen for cases that have been referred to us, not in situations that we implemented the avoidance scheme, but we have been asked to consider whether, in the light of counter avoidance units, scrutiny of the cases now, whether indeed there is any argument. And increasingly, we are seeing a great amount of resistance by counter avoidance unit to countenance any type of negotiation whatsoever. Their stated intention is to look solely at whether the scheme works or not. And there will be further cases, as we expect in the coming months, I'm almost certain. One of the areas that we are starting to see activity from HMRC on now is in the light of when the pandemic started 2 years ago and businesses were hit badly. A large number of employers applied for the furlough scheme to help out. So the coronavirus job retention scheme was called upon by a large number of employers. And those grants are now coming into the system whereby they need to be returned correctly to HMRC. And the thing to bear in mind, and what is coming to the attention of HMRC, is because HMRC have a record of all payments made out to businesses, and they are now seeing the returns by those businesses, typically through the CT 600, for example, and attachments. Is there any discrepancy between what was paid out under the furlough scheme and what is now being returned by the recipients of those amounts? And bearing in mind that for tax purposes, it's a receipts basis, not the way the accounts may have been prepared, which is typically on the accruals basis. If there is any mismatch, that will come to light in the way that HMRC systems are reviewing this information. And it's important to remember that all the grant income must be declared on the employer's tax return. And we are starting to see nudge letters, as they call them, going out to employers. Now, there will be many businesses who could be impacted by this, some of them quite innocently because they have just prepared the returns incorrectly, but it's important that these are taken very, very seriously. If a nudge letter along these lines is sent out, whilst it isn't in itself a formal inquiry notice, it's important to treat it very seriously and to take the action within the 30 days needed to explain and identify what the issues are so that it can be dealt with in good time. Because the risk otherwise is that if it isn't, or the information is inadequate, that it will lead to a formal inquiry notice being issued by HMRC, and which will then extend the inquiry significantly. Another area similar to nudge letters that we are seeing is what is being referred to as one-to-many letters. Now, these are letters that HMRC send out in a general style of writing. And what it seeks to do is to draw on, bearing in mind that HMRC now receive huge amounts of information from a wide range of sources. It comes into their computer system, which they call Connect, which is a hugely expensive investment a few years ago by HMRC in data gathering terms. And it's coupled with the fact that the personnel numbers within HMRC are less than they used to be. So what they do is they will write a letter in a general style which intimates that there may be an omission to a particular taxpayer's return, be it a corporate or by an individual. And we've seen it in a number of individual cases where they're looking typically for a specific item. For example, a number of cases that we have seen, which are quite straightforward to deal with, but it demonstrates how they can tackle these sorts of issues in a very cost-effective way. And for example, they will run a check from an employer perspective at the end of year returns that go in the P60 documentation, for example, and they will check it against the individual's tax return. And there may be, for example, an omission of a benefit because there either wasn't a P11D done by the employer, or the P11D was done, but the individual doing the return wasn't either aware of it or forgot to put it on their own return. So the mismatch arises. And that is where these one-to-many letters are starting to come from. And we similarly see it in individual cases where HMRC are gathering information from overseas as regards UK taxpayers that may indicate, for example, a property has been held but has been disposed of. So has that property had income arising on it, or has it now given rise to a chargeable gain in the UK? And the letter will be written in a style that might prompt the taxpayer to think, yeah, maybe, okay, we need to have a fresh look at that. And indeed, there may in certain instances be a correction needed. So the thing to bear in mind with these one-to-many letters is, whilst then, again, not a formal inquiry notice, they shouldn't be ignored, because otherwise it could in turn give rise to an inquiry notice. So the preferred course of action is plainly to make an amendment if necessary, and thereby also to make a disclosure. And that will tend to be the end of the matter from our experience. So it's important to deal with it on a timely basis. Finally, I just wanted to mention very, very briefly, we are seeing an increased activity in the area of what's known as Code of Practice 9 cases. We are seeing these cases referred to us for assistance and to help deal with them. Very briefly, what Code of Practice 9 cases are, it's where HMRC have a strong suspicion, at least, of tax fraud. And they, in those cases, make an offer to the taxpayer to invite the taxpayer to accept a contractual disclosure facility, as it's known, which, if the taxpayer does so do, and thereby agrees that the taxpayer will make a full disclosure of whatever the misdemeanor may have been for tax purposes, HMRC undertake not to launch any criminal inquiry. So the onus then is placed on the taxpayer to make a full disclosure. And we have seen instances whereby the taxpayer was under inquiry in what used to be known as the old district, if you like, by the inspector handling the case, more now in what's known as mid-sized business compliance. And for some reason, that line of inquiry has stalled. And all of a sudden, what has happened is that HMRC Fraud Investigation Service, FIS as they're known, they surface with a letter to the client saying, you are now being given the opportunity to enter a Code of Practice 9 contractual disclosure facility capacity case. If you would like to take that opportunity, you have 60 days to do so. And there's a process then to go through. The client doesn't have to agree to that, but the risk they run if they don't agree is that HMRC will then run their own line of inquiry, which may well lead to a criminal case. So it's important that these matters are addressed very, very quickly within that 60-day opportunity window and dealt with appropriately. There is a process to go through, but it's a set process and it can be dealt with. And it enables the practitioner and the client to keep control of the case, because HMRC in the meantime just sit back and wait for the disclosure to go in. So it does enable the client and the advisor to handle the case fully without any interruption at that point from HMRC.
Great. Well, thank you, Paul, and thank you also to James and Vicky. I do apologise for that technical hitch halfway through. My connection dropped for some reason, so I had to quickly dash around and try and get that sorted. So hopefully that wasn't too disruptive. we've got time for a couple of questions which have come in. June has asked, what about overlap relief? I presume there, June, we're talking in the context of the move to a tax year basis for unincorporated businesses. And yeah, overlap relief does come into play there in terms of that transitional period. You can take advantage or deduct the overlap relief that's arisen previously if you've got that number to hand, or HMRC have committed to providing that number. The whole issue around the change in basis periods is a big topic in itself, not something that I can cover off in detail in a session such as this, but what I will do is I will run a longer session purely on that, maybe in 4 to 6 weeks' time, something like that, which I'm sure will be of interest to a lot of people, where I can go into greater detail in terms of how the new rules will work. And one for you, Vicky, about junior ISAs. Just want confirmation that junior ISAs that hold stocks and shares are now to be registered with the Trust Registration Service. They're just saying that's not mentioned on the revenue website anymore, but I think it's such a fast-moving piece that maybe hasn't caught up yet. Is it?
Yeah, I think that is a situation where the manuals are useful, but they can't cover every single scenario. So unfortunately, junior ISAs, whether they're held in pure cash, whether they're held in stocks and shares, or I think it might be possible to have a combination of both, whatever type they are, junior ISAs would have to be entered on the trust register before the 1st of September is the current information available to us. It does seem strange potentially that you need to do it, but it is because of the anti-money laundering rules. So the only things that are exempt are pure cash deposit accounts with a normal bank and building society, but junior ISAs of any description don't count as that, so they would have to be entered onto the trust register. I hope that answers that question, and it may be that the manuals are updated in due course, but that's certainly all the guidance that's coming through at the moment.
That's great. Thank you, Vicky. I'm conscious that we have just gone past 3 o'clock now, so I don't want to keep anybody any longer. All I can say is that thank you all for tuning in. I hope everybody found that useful and informative. We'll be running a similar kind of session again in about 3 months' time.